Toxic financing, explained. The dark side of buying small-cap stocks: stock dilution. There's nothing wrong with dilution. Companies do it all the time. Large blue-chip companies like Apple continuously issue new bonds and other notes to fund their research and development. But small-cap stocks don't have the same financing options as large companies. So, they're forced into toxic deals that dilute shareholders to avoid bankruptcy. All companies are out for themselves. They'll do anything and everything to stay alive, including dump millions of shares to raise money. Small-cap stock toxic financing. The underlying reason for most small-cap stock runs is to help a company justify an offering with a financer. During this deadly cycle of dumping shares on retail investors, companies often run out of ways to finance their operations, leading to toxic deal structures. The best example of toxic stock dilution continually happens with DryShips Incorporated. DRYS. Stock. Adjusted for all the reverse stock splits, here's the current DRYS chart. Since 2016, the company has undergone numerous reverse splits and continuously issued new forms of toxic financing to help fund its operations. DryShips' financing forced millions of shares into the public market and caused the stock to fall in price dramatically. Regardless of a catalyst, news event, or the amount of volume traded on any given day, the structure of the finance deals didn't allow the stock to spike a considerable amount. It's a sad thing to see and one of the main reasons small-cap stocks have such a bad reputation. Many people invested in DRYS, but over the years, the dilution caused any investment in the company to be worthless. FCEL dark side. A current example of toxic stock dilution is occurring with FCEL, or Fuel Cell Energy, Incorporated. Since the beginning of 2019, the company has undergone multiple reverse stock splits and continues to dilute into shareholders. Every time the stock spikes, the company unloads its previous offerings, selling millions of shares onto retail investors. Information about the offerings is challenging to find and requires an understanding of SEC filings. SEC filings are extremely difficult to read because they're convoluted with business and lawyer jargon to hide the terrible dilution occurring behind the scenes. Because of the shady practices by financing firms and small-cap stock companies, newbies often buy stocks like FCEL when they begin to spike or when a new press release comes out. Sadly, time and time again, the company will sell its offering shares into the spike, causing the stock to dump and traders to lose money. The toxic stock dilution practices are legal because they're fully disclosed in the SEC filings. This dark side of small-cap stocks is rarely discussed and will never go away. For many companies, it's their only hope of survival. The only thing people can do is educate and protect themselves from the dilution. From a long-biased standpoint, traders should avoid stocks like FCEL and DRYS once they become massively dilutive. Shorting the dark side. The dilution throughout small-cap stocks is one of the biggest draws for new short sellers. However, most newer traders don't understand the foundations of trading and can't appropriately trade a dilutive company like FCEL. The truth about shady small-cap stocks. Small-cap stocks are a unique niche in the stock market because they're some of the most highly volatile and scummy companies on the planet, but they can offer incredible trading opportunities. Invest in your education first. The uneducated people are the ones buying DRYS or FCEL and getting dumped on from their shady offerings. Understand that not all small-cap stocks are worth playing. One of the first lessons from a daily chart and see if a stock has ever tried to run before. In cases like FCEL, it's clear there's something fundamentally wrong with the company. FCEL trended down for all of 2019 with many failed spikes. The failed spikes are a huge red flag for long-biased investment-type traders, but can be an excellent opportunity for short sellers. Small account? It's absolutely possible to be profitable with a small account, and it is possible to be consistently profitable without using a ton of margin or borrowed money. The lack of information and shady behavior of small-cap companies can help you get ahead. Sadly, toxic financing or other misleading practices happen, but if you can learn to take advantage of this, it could potentially help your trading bottom line. While there are no guarantees in the market, ever, some traders are all about these situations, under the right circumstances. Again, let me emphasize, longing small-cap stocks isn't a walk in the park. Over 90% of people fail to trade profitably. Buying small-cap stocks has a lousy reputation in large institutions on Wall Street. These tickers the worst of the worst companies. After all, small-cap stocks are small-cap stocks for a reason. But the problem isn't small-cap stocks. People aren't aware of the scummy practices that small-cap stock companies and their promoters use on a daily basis. Like, share, subscribe, ring the notification bell and leave a thumbs up. That's how you will get your high fives. Thanks.